Roth Conversions, before and after retirement. Let's talk about it. Welcome to the Modern Wealth Management Educational Series. I'm your host, Dean Barber, Managing Director of Modern Wealth Management in Kansas City. Special guest today, another Managing Director of Modern Wealth and also a CPA, Marty James. And we're going to be talking about Roth conversions both before and after retirement. Enjoy my conversation with Marty James. Marty James, CPA and Managing Director of our Indianapolis office. And we're talking today about Roth conversions before and after retirement. And I would be remiss to say that if I didn't mention you're also a CPA, this wouldn't be nearly as good of a program. And so we're going to talk about Roth conversions before and after retirement, Marty. And I want to start off, is a Roth conversion a good idea?
That's the big maybe. I think eventually it generally always will be, but it's a question of when you're going to do it. Are you going to do it before retirement, after retirement? And of course, that really plays into the whole financial plan where you're looking at that big long-term picture, and then you'll lay your long-term tax plan over on top of that. So that's when you identify, when should I be doing this? If I'm a high earner right now, well, maybe I don't want to, but maybe I have other techniques to get money into Roth while I'm a high earner. But not necessarily paying the taxes at these rates.
So, Marty, let's break it down to the basics as we begin this program. What exactly is a Roth conversion from the perspective of a CPA?
Okay, so from a perspective of a CPA is essentially we're voluntarily paying taxes on money today that we don't have to today, but eventually we have to. We have a partner in our pre-retirement or our retirement accounts that are pre-tax, and that's called the government. So we want to take them out as fast as we can and put as much hurt on them as we can, and creating more tax-free growth for us.
So you're going to voluntarily pay taxes now in exchange for tax-free growth forever.
Forever.
So a lot of it depends on income today. It depends on your age. It depends on your health. It depends on whether money is going to pass to a surviving spouse, whether it's going to be to children, to grandchildren. The Secure Act's going to play a lot in the decision to do a Roth conversion or not to do a Roth conversion. But I will tell you this, from the perspective of someone that's been saving into retirement accounts my entire career, and I assume you have as well, Marty, there's no better place to have money than in a Roth IRA. The question becomes, how do you get it in there in the most tax-efficient manner possible? And that's where the Roth conversion comes in. When do you do the conversion? Do you do it pre-retirement so that you have longer to let that money accumulate, or do you do it after retirement when you're in a lower tax bracket?
Yeah, and again, the answer, is probably both. So sometimes, the market will give you an opportunity to do that Roth conversion. We've talked about this before. I'm funding it with pre-tax dollars. Say my 401k, my plan allows me to do that in-plan conversion. Well, the government has loaned me money to do this, and if the market takes it down and I do that conversion, then I permanently get to keep some of that money that the government gave me based on my current tax bracket. So that can be, the good play. But then you have the other people who don't have that opportunity. Then you're looking at, okay, what is early retirement going to look like? And that will be really the deciding factor as to whether I want to be doing it today versus once I get into retirement.
Marty, I think I have what I would call the ideal scenario of Roth conversions. And that is, if I can start talking to somebody at least 10 years before they retire, I have a lot more ability to shape what account their money goes into, whether it's an account that's taxable each and every year, like a joint account, an individual account, or a trust or something like that, or whether it's going into a tax-deferred and tax-deductible account, or whether it's going to an account that I've already paid the taxes and then it's going to grow tax-free. Most people, Marty, are in their peak earning years from age 50 on. If they've built a good career, their income is reaching that peak in the 5 to 10 years leading up to retirement. And depending upon what that income level is, it may not make sense to make a Roth contribution to a 401k, and it may not make sense to do any Roth conversions outside that 401k as well. And it may be that since you're in your peak earning years, you're actually saving money in addition to what's going into your 401k, which is the ideal scenario. So if you have somebody that has 5 years to go before retirement, they're in their peak earning years, they're making more than they're spending, I think you got to set that extra money aside and you use that money that's already been taxed to live on for a few years in the early years of retirement. So you don't have any taxable income. Then you start doing those Roth conversions and you can convert. I think a married couple can go up to probably $95,000 today and stay in the 15% bracket, making their effective rate 11% on that conversion. So that's an amazing number.
Yeah. I mean, that is definitely a play that we definitely look at doing. But one of the times we've talked about the ACA premiums if I'm retiring before 65 and before Medicare. So in that situation, maybe it makes sense to do some Roth planning ahead of time. So I have those funds to use to keep my income under control to get all the tax credits I possibly can for that health insurance.
Okay, you just did CPA speak, and we need to make sure that we're speaking to the general public. ACA premiums and credits. Okay, what are you talking about?
Yeah. So in 2010, we ended up with the Affordable Care Act. And with that, they put in tax credits based on your income. So let's say your normal premium without any help from the government, it's going to be $1,000 a month. Well, if I can control my income during early retirement and instead of paying $1,000, maybe I pay $300 a month because the government's going to subsidize my premiums because my income's so low. And if we just think that that's a possibility, then we really want to be focusing on some Roth conversion early, or the year right before we retire, we do it then, and go ahead and cross the tax bracket because it can make sense because I'm going to be spending some of this money during those early years as I bridge to Medicare.
So what you're talking about would be especially effective for people who are planning to retire prior to the Medicare age of 65.
Correct. Because for those people, their actual effective tax bracket is going to be the highest point up until age 65 than it will ever be in retirement because of those tax credits.
So you got to think of that ACA credit as a tax.
Yes.
As a tax credit, right? So it's actually money that you're not going to have to spend.
Yep.
And so you could do that a couple of different ways. You could say, well, if I was making contributions in my early years into my 401k and I was using the Roth portion, then it may make sense to spend that Roth portion in the first 3 or 4 years to support my lifestyle because that doesn't show up as taxable income and I could still get the ACA credits.
That's correct.
But let's make sure that people are clear on this because I don't think those ACA credits are just that simple. If you have income that's coming off of tax-free bonds, while you may not be paying taxes on that, that still is going to count as income when it comes to the ACA credit, correct?
Correct. And if you think in terms of Social Security, say I file for Social Security at 62. Well, it's not just that taxable portion of my Social Security, it's the full amount that goes into that factor for that household income for your ACA credits.
And those numbers can be significant. I mean, I've seen premiums of for a married couple, you're looking at, $2,000 plus a month. And if you can get that down to $500 or $600, that's some big savings in those early years by qualifying for those credits, by getting your income structured the right way.
Yeah, it can actually turn your financial plan to the positive.
Marty, this is like the pre-post. Do I do it before? Do I do it after? And you said yes, probably some of both, right? But it all depends on your situation. We have people that are already retired and that will be viewing our educational series here, and maybe they're already of age where they're being forced to take their required minimum distributions out of their traditional IRA. Let's talk a little bit about doing Roth conversions when you're past the required minimum distribution age.
Yes, so we do a lot of those. And basically that's more of a bracket bumping thing. But we're not necessarily just bumping the tax bracket that we project them to be in for the long run. We're also factoring in those additional Medicare premiums, the IRMA charges. We don't want to cross that if we don't have to. So if we can keep them in that lower tier of Medicare premiums and still get our Roth conversions done, that's a win.
So one of the things that people have to take into consideration when they're doing a Roth conversion post required minimum distribution date is that they can't convert the required minimum distribution. So in other words, the required minimum distribution has to come out first. So let's say somebody's got a RMD that's $30,000 a year. Well, they got to take that $30,000 out, pay the taxes on it, and then they can still convert above and beyond that.
Yep, yeah, because that's a minimum distribution. That's not the maximum distribution. So we want to be sure we're taking advantage of that. Another thing you look at is the health of the two spouses. If I have a spouse that's terminally ill, and so that year I may end up crossing a little bit more. Because they're not going to be here maybe next year. So I may only have one more joint tax return to file. And after that, I'm on my own, which means everything's compressed and I get pushed in to higher tax brackets quicker, as well as a higher IRMA charge quicker. So sometimes it helps to kind of get ahead of that with a larger Roth conversion.
So the bottom line here is Roth conversions can make sense pretty much at any time, but it's really not a simple calculation. It's fairly complex, and it takes a thorough understanding of not only how much does a person have in an IRA that they may want to convert to a Roth IRA, but really you have to take into consideration what's the longevity, what's the current tax status, what's the spending pattern, what do we want that money to do when it passes to either the surviving spouse or the next generation, because as long as we live in the United States and either have money or make money, taxes are going to be a fact of our life. And as long as we have IRA dollars, whether they're the individual that owns them or whether they go to the surviving spouse or whether they go to children or beneficiaries, taxes are going to have to be paid at some point at some rate. And so the whole idea of this Roth conversion is to pay as little tax as possible on all that money that you got deductions for when you put it in and all the tax deferred growth that you got. How do we get it to a tax-free environment with the least amount of tax as possible? I think that's what you're saying when you say maybe some before, maybe some after.
Correct. It's just taking advantage of whatever it is to have that lifetime tax as low as possible. Which let's talk about the situation. Say we have some elderly parents and they do have pre-tax IRA money, and I have my children are pretty well to do. So maybe, the children talk to the parents about, okay, what if we convert your Roth, your traditional IRAs to Roth? We will pay the taxes on it. So they're going to inherit tax-free money.
So the CPA firm's going to pay the tax?
No.
You're saying the children would pay the tax.
The kids will actually, pay that tax on that in the form of a gift going back to the parents. So instead of being like the bank of mom and dad, this is the bank of your kids coming back to you.
Right.
So,
and I think you're making a great point there, Marty, and that's especially critical to be considering. Let's just say that, you're in your mid to late 50s, you're in your peak earning years, you've got elderly parents that are in a much lower bracket than you are, but they've got money in traditional IRAs that when you inherit that, you're going to be forced to take all that money out over a 10-year period and likely at a much higher bracket than if your mom and dad were to do a conversion now.
Yes. Yeah. The government's got this figured out.
Eventually the tax is going to be paid.
Exactly. So the only thing that could possibly really screw up that plan would be a long-term care event for the parents, which is where that long-term care planning could really come into play also.
What do you mean there? Explain a little bit more.
So let's say the parents, they don't have a lot of money, but they do have money in that pre-tax account. They go into a long-term care situation. Well, we have to spend that money down, and eventually maybe they qualify for Medicaid. Well, if it's in a Roth, they would still have to spend that down. So if the child is going to be paying the taxes on that conversion, they want to be sure that money's there, for them. So that's where the long-term care planning would really come into play. So that would be the thing that you would want to shore up if you took that approach with the kids paying the tax on the conversion.
What about for the parent, the elderly parent? Again, I'm thinking about this you could look at it from both ways, but generally if you've got an elderly parent or an elderly individual that's needing long-term care, whether it be assisted or skilled, that individual is probably not in a position where they're making the most intelligent financial decisions because they probably got some diminished capacity at some level, right?
Yes.
So What about the situation, Marty, where you have your mom and dad, maybe it's your grandparents, and you know they've got IRA money, you know they've got other money, and they do have a long-term care type of a situation, but they've got assets to pay for that. There's some tax deduction that's going to come into play with those expenses in long-term care. Should you use that as an opportunity to potentially offset some of those tax deductions with some Roth conversions for that elderly parent?
Yeah. So what would happen would be, let's say they're actually in, say, a memory care unit, and so we have all these medical expenses, and just being in the facility becomes that medical expense. That becomes an itemized deduction, which is not totally efficient because of that 7.5% haircut, and then they got to go over to the standard deduction. But that could give you some additional room to actually do some conversions on this money.
And those conversions could actually be done tax-free because you're going to get the deduction that's being offset by the expenses for the long-term care.
Right. For federal purposes. Most states base it on an adjusted gross number, so you may not get the state savings, but federal you definitely could.
Let's just wrap this up, Marty, by saying that the Roth IRA tax code introduced by Senator Roth in the late 90s is perhaps the best legislation ever written when it comes to the tax code. And everybody should be asking the question, how do I get as much money into that Roth IRA as possible, but doing it in the least taxing way possible? From a CPA's perspective, is that a smart way to look at it?
That's exactly it. I mean, I think the whole Modern Wealth team, what we do is we try to figure out every day when we get out of bed, how much money can I get into Roth accounts tax efficiently?
Yeah, and it generally never happens quick. It's generally a long-term planning scenario, and tax laws change, economic conditions change, market conditions change, and that can change our strategy from a year-to-year basis. So it's not a set it and forget it type of a scenario.
Exactly. You can do that long-term plan of what you think it's going to look like, but there's always adjustments that you're going to be doing every year.
Marty, I really appreciate you taking time to join me here for the Modern Wealth Management Educational Series. I know that this is a complex situation. I know that what we did today really just is the tip of the iceberg on what people need to know about Roth conversions. It's really critical that you work with a good, qualified, certified financial planner that has a CPA on their team that can make sure that if you're going to consider Roth conversions, that it's happening at the right time of your life and you're getting money in there in the least taxing way possible. Marty, appreciate your time.
Thanks, Dean.
If you're watching us on YouTube, make sure and give us a thumbs up. Click the bell icon so that you're notified every time a new episode comes out, and make sure and share this with your friends.